I recently hosted a live webinar where I shared my strategy for using covered calls to generate a monthly income. And literally overnight, I was bombarded with emails and private messages asking me to post and replay that webinar on my YouTube channel. So here's the deal. I'll go ahead and post the replay here on my channel as long as you promise to smash the like button. Thanks for pressing the like button. Now here's the replay of my webinar. Welcome. We got about one more minute before we get started here, but I just wanted to say welcome to this live stream. I'm so excited to be talking with you today. Today's topic, we're going to be talking about basic options trading, and in particular, one of the strategies that I've been using. So we'll wait one more minute, see if some more people join. But like I said, I'm hoping that you get a lot of information from this. I'll be talking about basic options trading, one of the strategies that I've been using for a while now in order to generate an income. And so it's really exciting for me to share that because it works really well for me. I think it's a really simple concept to understand. And so I'm getting ready to share it with all of you. So if you're new to options trading or you're just a beginner and you're learning about options trading, this is the place to be. I'm going to let you in on one of the options trading strategies that I use. We'll wait one more minute, see if some additional folks join here. But it's going to be really exciting. And I'm hoping I can answer a lot of questions, provide some helpful information, and hopefully you get a lot of good knowledge from it, and perhaps it helps you out in the future as well. All right, so I'm seeing it's right about 3:30. Why don't I go ahead and get started? Again, I'm really excited. My name's Jim Ray, and welcome to my Simple Option Trading channel. And this is my live stream that I'm doing right now. It's for all of you. It's for anyone that wants to listen in, but I've geared it more for new option traders, or someone that's maybe beginning or thinking about being an options trader. Maybe you've got some questions, and so hopefully this is one of the live sessions where I can answer those for you. Just as a little bit of background, I typically do anywhere between 7 or 8 different options trading strategies. So I won't go through them all, but I'll give you the one that I'm using, or one of the ones that I'm using right now. It's actually pretty exciting. So I'm going to go ahead and get started. Again, I'm welcome so much. I really appreciate all of you joining here. I'm going to give this live session discussing what I've been talking about in a part of my YouTube channel for the past almost, let's see, not quite 2 years, but coming up a year and a half maybe. And so I think this is a great opportunity to get live, talk a little bit about what's going on, how I'm trading, and share the information so that maybe, if you're on the border, maybe you're not option trading yet. And maybe this is the one thing that you need, is the opportunity to ask some questions, get some information, and you can learn about some of the strategies that options traders such as myself. I think you'll notice there's a lot of options traders on YouTube. I'm just one of many. I'm just a random guy. I'm by no means an expert, but I wanted to share with you the success and strategies that I've been using. And so hopefully this helps you out as well. Okay. So let's go ahead and start taking a look. First, let me start off by saying, here's my promise to you. I'm going to teach you how I trade stock options in order to generate a monthly income. And like I said, I do a number of different options trading strategies. And I think in the series, I'll probably step through each of these so you get an idea of how each of them work, what the possible profits are, potential losses, what's the risk reward that's going to match with your particular option trading strategy. There may be a strategy that works well for you and some of the others don't, or maybe they all work for you. And, the only way you're going to find that out is by learning what they are, figuring it out if they map with what your particular situation is, and then maybe you try them out, right? Try them out on paper first. And it's almost like a game, right? You plan an option strategy, you execute it on paper. You don't actually risk any money doing the trade. But once you do that, you can see whether or not you've been profitable or not, or what mistakes you made, what you learned from those options trades. And then again, I hope I'm a resource that you can come to and ask questions about some of the options trades that you've been doing. So now, like I said, what I want to do is share the options trading that I'm doing, how I generate an income, and how I use this to supplement, the money that I have in my account. I'm not giving trading advice. I'm not recommending. I'm not suggesting. I'm not trying to do anything like that for because your own situation, well, that's particular to you. I'm trying to relate to you what I'm doing, what works in my situation, and along those lines, I'm documenting what I'm doing and then making these videos and sharing with you exactly what I'm doing so you can see and maybe decide for yourself. Now, what's great about it is, um, as part of my mission statement, right? Simple option trading. I wanted to make sure that what I'm doing doesn't require any special technical knowledge, right? I don't have a financial background. I don't have any financial expertise. I'm not skilled like that. I'm just a random guy on YouTube making these videos, but I'm sharing my experience and what I've been learning along the way. And so hopefully you'll get some idea for yourself what works. And then also, one of the things I always hear about from people I talk to when I mention that I'm stock option trading is they will often ask me, well, don't you need thousands and thousands of dollars? Don't you need lots of money to make money? And what I will tell you is, it doesn't require having thousands and thousands of dollars, right? Now, obviously, maybe you've heard of that saying: the more money you have, the more money you can make, or it takes money to make money. That's definitely the case, right? So if you've got more resources available, then obviously, you're risking more, and as a result, potentially your rewards will be greater. But also the flip side of that is, if you're risking more, the reason it's called risk is because you could also potentially lose that as well. And so what I've tried to do over the past a year and a half in my videos is kind of explain what I'm doing, what the profit potential is, but also mention what the risk is. What's the downside to doing all this, because that's really one of the questions that comes to mind when new or beginning options traders think about getting involved in something like this. They want to know, what does it cost me? How do I do it? How much can I lose? In addition to how much can I make from it, right? So, it's a double-edged sword there, if you will. And so what I want to do is explain to you what's at risk, what's the possible reward, or what's the possible loss. So, in this video or in this live session, I'm going to explain to you what's the magic behind stock options. And I use the quotes magic because it's not really magic, right? All the information is out there. It's a very regulated and controlled process, trading options, right? There's no secret about it. There's no magic per se. It's that some people have taken the time to understand how the options work, how options trading works, and they apply that knowledge to their trading activity. And what they're doing is they're taking a certain amount or measured risk in hopes of making a measured gain. And so that's really what it's all comes down to. It's not magic. It's applying the processes and the strategy of using stock options to generate an income. And that's what I really hope to share with you, is my strategy for making money using stock options. I do this on a regular basis. And just to be honest, I don't win everything, right? I'm not 100% winner, but I'm not 100% loser either. And the goal is to make money while risking some and minimizing the losses. And so if you can come up with actually earning more than you're losing, then that's, the net effect is you're actually coming out ahead. So if anybody tells you that they're winning 100% of the time, I kind of look at them sideways and I don't think that's the case. And I'm not trying to do that, right? So I do have losses. I do make profitable trades. I do lose money on some trades. And, the idea here is, share the strategies with you. Look, so that you can see what's the possible reward. What could you possibly lose? And my strategy, in keeping with the theme of my channel, simple option trading, my goal is to make option trading simple. It doesn't need to be complicated. Now, there are nuances and complexities that can make it difficult, but my goal is to show you the strategy that I'm using, that makes it easier for myself to understand and to execute, and it's very profitable. Now, I may not squeeze every single last penny out of a trade. Granted, I'll give you that, but but I am making a profit, and so like I said, I want to share this with you, and so you get to see how I'm doing it. All right, let me see here. Let's go to the next here. Okay, so the question is, how did I get here, right? I'm talking to you today. I've got a YouTube channel that I've been publishing for the past year and a half. So, what makes me the guy to bring this information to you? So let me see if I can. There we go. That's a little better. You can still see me, right? Okay. Well, really, in my trading history, there's been two major events that affected me in my trading, and that's what led to me being to where I am today. Options trading, creating a YouTube channel, and sharing my experience and the things that I've done in options trading. And so let me walk you through those two events. So here's a kind of a timeline of my trading activity. You can see where I started, which was a long time ago, to where we are today, and these two major events that really bumped up my trading. And these two events, as you'll soon see, were very pivotal for me. Let me get this date out of the way so you can see it a little bit better. There you go. So it was very pivotal for me to there. How about that? There. Now you can see the whole timeline, right, start to finish. These two events were very pivotal to me, and once I explain them to you, I think you'll understand why they were pivotal, and what changed so much. So when I first started trading, I was really doing just buy and hold investing. Some of you may have a retirement account like a 401k or a TSP or something like that, where you're buying stocks as part of a retirement fund. Maybe it's a mutual fund, or maybe you're buying individual stocks, and you're accumulating stocks, and you're not really trading them per se, right? You're buying them and holding them for the anticipation that you'll retire one day and that the stock values will be higher, and so you've accumulated some wealth over time. And so that's really what I was doing when I started out. I was a young man just starting out options trading. And so my goal was to just accumulate wealth through these stocks, right? Investing in stocks in the bigger type companies, the Wells Fargos, the Coca-Cola, the AT&Ts, the Apple computer, in hopes that one day the stock values would be higher. And so I was buying and holding. And what's interesting to note here, and I want to make sure let me emphasize this. I want to jump in here so you can see what's interesting to note, that when you're buying and holding these stocks, at the time when I started, all of my trades required me to go through a stockbroker and pay a commission, something called a fee for processing my transaction. So if I wanted to buy a stock, I needed to pay the stockbroker a commission for executing that trade for me. And likewise, if I wanted to sell the stock, I would issue a sell order to my stockbroker, and he would charge me a commission, a fee for actually executing the sell. And so what ends up happening then is you pay to buy the stock, and then you also pay to sell the stock, and those fees are they were unrecoverable at the time, right? So there was just the fee, the cost of doing business. That's like if you have someone come to your house and paint your house, well, the person painting your house is going to charge you a fee for performing a service. And so that's exactly what back then what the stockbrokers were doing. And this is back in 1990. You went to a stockbroker, you placed your orders, and the stockbrokers charged you a fee independent of what happened with the stock, right? So if the stock shot up or the stock price dropped, you still had to pay the fee no matter what. And so that's what I was used to, right? I had to buy a stock and I would hold it. That was part of the impetus for holding a stock, right? I'm going to buy the stock, pay the stockbroker his fee, their commission fee, and then I'm going to hold on to it. And hopefully the stock price goes higher. So when I retire and I eventually sell the stock, I still have to pay the commission, but it's a smaller percentage, right? So, and I guess the point here is people weren't buying and selling stocks every single day. You've heard of day traders. Well, people weren't really day trading back then because, there were day traders, but the fact is, in order to day trade, you'd have to pay two different commissions, one to, sell the stock or buy it, and then another commission to do the opposite of what you just did. And so it was really preventative, if you will, to pay those commissions. So really it was just buying and holding the stock. And so what happened after that was this first event. And in February of 2014, a company called Robinhood, some of you may have heard of this trading platform called Robinhood. You'll see the app on a lot of people's smartphones. I tend to use it a lot as well. But Robinhood was a broker that offered commission-free trading. And so that was a big deal. now I could buy and sell stocks on a daily basis and not have to pay that commission, right? So I'm not paying to buy a stock. I'm not paying the broker to sell a stock. And back in the 90s, you'd pay $10 to buy a stock or sell a stock. And eventually it dropped down to like $4 or $4.95. I think Scott Trade actually brought it down to, that $5 level. But initially when it started out, I was paying $14.95 for each trade. So if I bought one share of stock, I'd tell the broker to execute my trade for me for that one share, and I'd have to pay for the share plus $14.95, the commission fee. And if I turn around and sold the share, well, then I would tell the broker, hey, sell my one share, and the broker would sell my share, and then when I got my proceeds, the broker would automatically subtract $14.95, their fee, for executing that trade for me. Now it got down to $9.95 and then $4.95 or $5, somewhere in that range. And then in February of 2014, Robinhood introduced zero fee commissions, and that changed everything for a lot of people, not only myself. You can imagine, right? Day traders could now trade stocks, buy and sell stocks continuously all day long and not have to worry about the commission fees, which beforehand, in January, just a month before, they were paying commissions up and down, left and right, and that ate into their profits. Well, now they didn't have to worry about it, all because of Robinhood. Now, Robinhood was the first broker that introduced commission-free trades, and then soon after, the other brokers knew that they were missing out, right? Millions of traders, or maybe not millions, thousands of traders flocked to Robinhood and started using Robinhood as a trading platform. And so the other brokers, in order to stay competitive, needed to fall in line. And so they started doing zero-based commissions, zero fee commissions as well. And so if we're looking to thank anyone for doing that, this getting rid of the commissions we used to pay, we need to thank Robinhood as being the one company that started out being the one in a sea of many brokers that said, hey, we're not going to charge you a commission, come on over. And so that's what Robinhood started doing in February 2014. And because of that, I went from being a buy and hold trader, and now I became a swing trader. Now, if you're not familiar with swing trader, this is a person, well, how about this? As a day trader, you buy and sell stocks on a daily basis, right? So you typically buy a stock and you trade out of it, you sell out of it that same day in general. And that doesn't always have to be like that. But in general, you're buying and selling a stock or a position in a stock during one trading session. And that's part of being able to buy and sell, right? Now, as a swing trader, what I would typically do is I would look for stocks that are in a momentous position, right? I see momentum either moving up or moving down, and I would try to take advantage of that. Oh my goodness, hold on. I would try to take advantage of that by the fact that, well, I know I anticipate that the stock price will be going up over the next couple days. I'm going to go ahead and buy the stock, and then, in a couple of days, hopefully the stock price has moved higher, I'll go ahead and sell it at that point. And so that's really what swing trading is all about, is you're holding the stock or the equity for a longer period of time. You're trying to take advantage of the stock's price movement. Maybe it's trading in a range and you want to take advantage of that, or it's hit a support level and you think it's going to be moving back up to resistance. So as a swing trader, that's what you would do. Now, what happened after that was event number 2. In March of 2020, we had something called the global pandemic, and this was a huge event, not only for myself and the United States and North America, but the entire world. I think nobody could avoid what happened, and as a result, we saw a lot of companies and industries get hit by this, right? So in the business aspect of it, people were being forced to stay home. We couldn't go out. Remember, right in the beginning, we were, everybody was, don't come to work, stay home, right? And that was it. There was no contingency plan about working remotely because nobody had really thought about that. And as a result, we saw industries crumble and fall. In particular, the hospitality industry, right? So the travel industry, airlines. We saw hotels take a drop. We saw the food industry, restaurants take a drop. And so what did that look like? Well, the stock market fell, right? And so if we take a look at this daily chart here, you can see that in March of 2020, as a result of the global pandemic and everybody staying home and not going to work, we know that people weren't traveling, so they don't need airlines. They're not going on vacation, so they don't need hotels. And we're not going out to eat. So the restaurant industry also was affected by this. And it was a snowball effect. Everybody started having difficulties. Companies were telling their workers not to go home. And we're still seeing the residual effects of that, right? So we have supply chain shortages because things that would have been manufactured or produced back then have they weren't being produced, and so as a result, this effect of not having enough materials or raw materials or products available is prevalent today. And so you know this was another one of those things. This is the second activity that really affected me, right? And the fact that the stock market dropped the way that it did affected my swing trading. Now, if as I mentioned with swing trading, I'm buying and selling stocks. But remember that after March of 2020, and we had this precipitous fall of the stock market, what happened? We had almost a perfect V-shaped recovery, right? So the stocks dropped, and then almost as quickly, not quite as quickly, but over the next following months, the stock market started climbing back up. Now, I could buy and sell stocks, right, as a swing trader, but one of the things that I decided to do was to start trading options, because options has, as I mentioned earlier, the magic behind options. There's something that I can do in options that I couldn't do with stocks. And I'm going to explain to you what that is in the next couple of slides here. And so you see why I switched from swing trading stocks to actually trading stock options. And it's been since March of 2020, 2 years. And I traded options before, but because of the commissions I was paying, I did it as an experiment. Okay, can I do it? Do I know how to do it? Yeah, I understand it. But then after this global pandemic, and we saw the sheer drop off of the companies and the changing of industries, I decided to step up my game and not swing trading anymore, but do options trading, because I knew that I could leverage the ability of stock options and start making more money more quickly. And so that's why I love stock options. That's why I love stock options, is because it did give me that advantage to recover more quickly and give me more opportunity. And I'll explain a little why in a minute here. And so, since that time, I've made hundreds and hundreds of options trades since that time. And so I've gained a lot of experience. I've had winners and I've had losers. So there's profits and losses, but overall, I'm net positive. And now I'm a lot smarter about how I do my options trading. And so that's kind of what I want to share with you now is, hey, take advantage of what I've learned, and I'll show you my strategy and see if maybe this will work for you. Okay. So one of the first strategies I use, and that's the one that'll be the focus of this particular talk, is I used covered call options. Now, if you're familiar at all with options at all, covered call options, I think, is a really good option trading strategy. And it's particularly good if you're new or a beginner to options trading. In fact, for myself, this was the first type of options trading that I did way, way, way back. And it's because I was able to leverage shares that I already held. Okay. So as a buy and hold investor, you saw in the beginning I started buying and holding. So I have a portfolio already under my belt that held shares of stocks that I was planning to hold for a long period of time until my retirement. As a swing trader, I still acquired stocks, sold some stocks, but like I said, I had a portfolio of stocks already in my account, and using covered call options was the natural extension or the next step for me to take in order to do options trading. It's because I held the stocks, and I'll show you why. Right. So the stocks, just walk away with this, knowing that the stocks that were in my portfolio allowed me to do options trading very, very easily. It was a natural progression. So first thing we should talk about is, what is a stock option? Because I'm assuming some of you are new or beginners and you may not understand. So let me just read this real quick. All right, so stock options, a contractual agreement between two parties that facilitates the buying and selling of an underlying stock at a fixed price before an expiration date. Well, what the heck? That's a lot of words, right? What does that really mean? So let me walk you through it, and hopefully in the next 30 seconds or so, you'll understand what I'm talking about. So, the stock option, it's a contractual agreement between two parties, right? You got a buyer and you got a seller. So those are your two parties that are dealing with a stock option. Now, a single stock option controls 100 shares of stock. And so this is one of the magic characteristics or attributes of an option. It's because that one option, that one stock option, allows the individual to control 100 shares of stock. And so what that means is I don't have to buy 100 shares, right? This is probably the easiest thing to understand is I could either buy 100 shares of Apple stock at $150 a share, or I can buy one stock option at considerably lower price, and I still have control of those 100 shares. So it allows me as an investor to control those 100 shares of stock without actually having to purchase the shares. So this is an awesome deal. And I'll show you some real numbers so you get an idea of what I'm talking about. But first, let's finish up. Let's talk about a stock option. So we know it's a contractual agreement. We know there's a buyer and a seller. And we also know that that one option will control 100 shares of stock. And so as a natural progression, right? So if we're talking about two options, well, that's 200 shares, and three options would be 300 shares, and so on. All right. So for each option, there's something called an underlying stock, right? And it's the asset, it's considered the asset of interest. So if I have a stock option and it's dealing with ABC Incorporated, that means that this stock option controls the stock, those 100 shares of stock that are associated with ABC Incorporated, right? So it's 100 shares of ABC is what this is talking about. Next, there's an expiration date, and that's the effective period of the option. How good or how long is this option good for, right? So there's a validity period that says the option, this stock option is good from this date to this ending date, right? So there's a start date and an end date. And anytime before that, it's not valid. And anytime after that, the option is not valid. So just like a contract or by definition, a contract has those dates in there. So when is it valid, when is it not valid. And so this stock option is, as we see in the beginning, it's contractual agreement. And so it does have that start and end date in there. And the last thing I want to mention about a stock option is something called the strike price. Now, this is the agreed upon price to buy or sell the underlying stock, right? So if we take a look at this little graphic here, we see that there's a seller and a buyer that had entered into this contractual agreement, this stock option, and it's relating to this company called ABC Incorporated. So it's for 100 shares of ABC Incorporated. We know that the option contract expires on January 20th of 2023, and the price that buyer and the seller agreed to is at $100. And so that's $100 per share. So this stock option controls 100 shares, and each of those shares has a price of $100, and that's called the strike price. And so that's really what an option is. It's nothing more than a contractual agreement, and it has some identifying or characteristics in there that tell you what stock is involved, what's the validity period, what's the expiration date, in other words, and then what's the price that's involved, is what's known as to the strike price. Okay, so let me walk you through an example, and hopefully it'll make it a little more clear as to what's going on here. So what you have here is a graphic depiction of me on the left. You can see me standing in the green on the left-hand side. And on the right-hand side, we've got the stock market. And that market has, some buyers involved. Now, for me, I mentioned that I buy and hold stocks. And so as a part of my portfolio, I have 100 shares of stock, say, for company ABC. And what I decided to do in this example was to sell a covered call option contract. So you can see the underlying stock, the ticker symbol ABC. I've got the strike price of $100 and an expiration date of January 20th of 2023. And so I've decided to sell a covered call option contract for the 100 shares that I own. And so I put that out on the market, letting everyone know that I'm deciding to sell a covered call option. And then at that point, the buyers in the market will take a look and they'll see me, and interested buyers will go ahead and say, hey, I want to buy that covered call option. So what do they need to do? So what they're going to do is they're going to see the covered call option contract they're going to want to purchase that option contract, and as a result, they'll go ahead and pay the premium payment. So there's a premium payment, and what they will get in return by paying me that premium is they'll now own, or they'll have control or the rights to exercise that option contract. Okay, so now they can exercise the option contract. They get to decide, um, or they have the power or the right, not necessarily the obligation, to purchase the shares that I've sold as part of this covered call option contract. They have the right to execute the option contract at the strike price, the $100 per share, on or before the expiration date, so January 20th of 23. Now, let's go fast forward a little bit and take a look at what the possible outcomes are. So outcome number one is where, like I mentioned, the buyer will get assigned the shares. So they want to purchase the shares. And the reason this happens is because on or before the expiration date, the market price will be greater than the strike price. Right? So if the market price of the shares of ABC stock are $110, then the buyer, because of this option contract, they know that they can execute this option contract and only pay $100 per share. So they're going to go ahead and do that. They're going to go ahead and execute the option contract, or it's known as exercising the option contract. They're going to pay the $100 per share because that's what we've agreed to in the contract. So I'll have to sell my shares to the buyer because they decided to exercise it. So they're going to pay me the money, the $100 per share, and in return, I'm going to give them the 100 shares of stock, even though the market price is above my strike price. And that's the terms of the contract have obligated me to sell my shares at that price, and so that's why the buyer is able to do that. So they get my shares, but in return, I get the money that they paid for those shares, and I'm going to keep. You'll see that I've got paid for the shares, plus I keep the premium payment that I received. All right, let's take a look at the other outcome that's possible. And this is where the option contract expires worthless. And what do I mean by that? That the contract expires worthless. Well, it's really simple. It's that on or before the expiration date, the market price is below the strike price. So the current market price never reaches the strike price. Let's say it gets to $99 or $99.99. So it's just under the strike price. Doesn't matter if it's 1 penny or $10. That option contract expires worthless, and because in the agreement, um, the buyer, me, or the seller and the buyer, we've agreed to an execution or a strike price of $100, and unless the market price is above that strike price, this option contract is null and void and cannot be executed. And so, as a result, this covered call option contract expires worthless. But take a look here, me on the left, I still have my 100 shares of stock, and I still have the premium payment that I was paid. So I'm actually coming out of this ahead, right? I still have my shares, plus I have the amount of money I received as the premium payment. And so that's part of the strategy, or that is the strategy, right? Is if I own these 100 shares of stock, I'm going to sell a covered call option contract, me as the seller. Someone's going to buy this contract for me. And what I'm anticipating, if I choose the correct expiration date and strike price, the probability, if I do it correctly, I'm going to swing it or configure it such that the probability or the odds are in my favor that the option contract will expire worthless, and that I'll end up with keeping my shares and also keeping the premium payment that I received. And so this is one way for me to generate an income using my shares of stock. Now I could do this over and over again. I don't have to just use ABC, whatever shares of stock I hold in my portfolio. Generally, if there's options being sold, I can use them in groups of 100 to sell option contracts. All right. So that's a real quick example of how options contracts work, where me as a seller, I'm selling a covered call option contract, and as a result, I'm collecting a premium payment for selling that option contract. And then my goal or my strategy is picking the right expiration date and strike price such that the market price never reaches that strike price. And as a result, the option contract expires worthless. And that allows me to keep my shares and also keep the premium payment that I received, as that's part of the money that I'm making. That's the income that I'm generating. All right. All right, let's take a look now. We'll go back to our original slides here. And let's take a look at the next thing. And so one of the things I want to dispel a couple of the things that I've heard beginning or new investors ask me. They say, hey, stock options are just dangerous. In fact, I get comments on my videos about this. I was looking at my YouTube channel and I saw some comments from some folks, just one or two, and they mentioned, hey, don't do this. This covered call option trading is so dangerous. You'll lose all your money. This is a good way to go broke. And, this is infinite loss kind of thing. And that's really couldn't be further from the truth. Covered calls by their nature, the maximum you can lose is the shares, right? So your shares get assigned. So you actually lose those shares, so to speak. They get assigned to the buyer. But in return, you get paid money for those shares. So you're getting compensated. But, the fact of the matter is, let's say the strike price is $100, but the price actually jumps up to $200 per share. Well, I'm forced to sell my shares at $100 per share. It doesn't matter what the market price is. It could be $1,000 per share. Contractually, I'm obligated to sell my shares to the buyer when my shares get assigned to the buyer. I'm obligated to sell my shares at $100 per share, even though the market price is $1,000 per share, or whatever the number happens to be. So it's been a trade-off, right? So there's no infinite risk there. There's no infinite loss. I could lose my shares, so to speak, to the buyer, but I'll get compensated for it. Those shares will be purchased. The buyer will purchase those shares from me, so I'll get the money for those shares. But I miss out on some of that upside potential, obviously, right? So if the share price doubles or triples or quadruples or whatever, I don't get to take advantage of that. I only get the $100 per share. And so that's what the downside is in this particular scenario. So as I mentioned, covered call options have a limited loss, but they also have a limited gain. So there's I've controlled what I can lose and how much I can make. And so I don't have an infinite loss possibility or an infinite gain possibility. It's very controlled. And as it turns out, I get to set what those parameters are. I get to decide how much I'm going to possibly gain or how much I might possibly lose within reason, right? So there's no infinite loss. The absolute worst case scenario would be I were to sell a covered call option and then the company would the next day go bankrupt and my shares are now worth zero. The option contract would expire. I still keep the premium amount that I received, but now my shares are worth zero. And so that would be the absolute worst. But the other shares that I hold, the other money that I have in my bank account, savings account, I'm not personally liable for anything else. So I've actually limited my loss in that respect. But that would be the worst case scenario, is if the company, the underlying company, that ABC Incorporated, if that company went bankrupt, then I would lose everything, right? Or I would lose the value of those shares, I should say. I'm not losing everything. I'm losing the value of those shares. So that would be my infinite loss, so to speak. All right. The second secret, or the second thing I want to talk about is, some people that I mentioned that I talked to about say, well, they don't have a financial background. They're not a financial expert. They didn't take classes in finance or economics. They're not a math whiz, anything like that. And to that, my response is, you don't have to be. I think I mentioned earlier, right? It's all about my simple option trading, right? I wanted to make it simple on myself. Now I made and as a result, I'm not squeezing out every last penny of profit that I could possibly get. But my trading is a lot easier. It's I don't want to say relaxed, but it's easier for me. It's not as complicated, and I found a strategy that works really well. In fact, in order to prove myself, what I did was I ended up teaching it to my son, who was still in high school at the time. He's older now, but at the time I taught him how to do this, and he was a high school student, right? So he's not He's not a college student. He's not a college graduate. He's doing high school math, and basically, can you balance a checkbook? Do you understand profit and loss, right? So if you paid a certain price and you know that you sell it at this price, that difference is your profit, or you bought it at a price and you sold it at this price, you know that that difference is your loss. And really that's what it comes down to, is calculating your profit or your gain relative to how much you actually paid for the equity. Now, the biggest challenge I had with teaching my son the strategy, I don't know how many of you have teenagers at home, or maybe nieces or nephews that are teenagers, but you can't just sit down and talk to them and teach them a subject. You know why? It's because they always have a phone in their hands. They're always texting. Maybe they pay attention for a minute or so, but then the phone beeps or bings or dings or whatever it does, and they pick up their phone and they're texting their friends. In fact, they're texting their friends and they're in the same room sometimes. I don't know. It's a younger generation thing. So what I ended up doing was creating some videos for my son so he could watch them as he needed to, as he was ready to watch them. And he learned my strategy completely by watching my videos. And now he's able to option trade just like me. And he didn't have a math background. He's not a finance or an economics major. He's just a regular kid. But I gave him a way to actually learn about options. So that was nice. But my point here is, don't have to be a math expert. You don't have to be a college graduate. You don't have to be a CPA. Don't have to be an accountant or anything like that, or a Wall Street whiz or anything like that. This is just what I do, and how I'm profitable with this strategy. And I'm neither of those things either, right? I'm not a math whiz. I don't have the finance background or economics. Um, I do have trading background now, but only because I've been doing it for a while now. So I gained my experience over time, kind of on the job trading, on the job training, if you will. So the school of hard knocks, right? I made wins, I got losses, suffered losses, but I figured out what works for me, and I was able to teach it to my son. And so that's really that's all I wanted to say is, it's you may think you may be unable to do this, but I challenge you. I think anybody could do this if they just take a little bit of time, get to understand the mechanics of it, and you'll see that it's actually pretty simple. The other thing I want to talk about was the fact that some people mentioned, well, and I mentioned this earlier, in order to make money, you got to have money, and that's true. You do to trade stock options, you have to have some money. You can't come on there with zero. But I think everybody can come in there with something. It doesn't have to be thousands and thousands of dollars. Now, obviously, if you have $100,000 in your trading account, that's awesome, right? That means you can do a lot more things, and your risk reward is a lot larger than someone else who only has $10,000 in their account, or $1,000 in their account. And what I've been able to do, in fact, if you look at some of the videos on my my YouTube channel, you'll see that I've published videos about option trading, my own personal experience option trading, using a small account. In fact, I've got some here. You'll see I've got $300 in an account, or $500 in a trading account, even $50 in a trading account. So I've tried to make videos that apply to not only myself, but that might be of interest to others. So check out my YouTube channel, find out what I'm doing, how I'm doing it, and you'll see that I've got some videos there for specifically those people that have smaller type trading accounts. Because in reality, I mean, that's really what um, that's what real people are, right? Not We don't all have $1 million in our trading account. We've got some cash available, whether it's 10,000, 1,000. Um, I've got a $500 account challenge. I've done trades with with a small amount, as small as $50 to make a trade. So I would just recommend or suggest, go check out my YouTube channel. There's lots of, and not only my channel, but check out other channels. There's other channels as well that talk about options trading, and you don't have to have a large account. So this is very doable. And if you don't have, let's say, what if you only have $10? What do you want, $20? Um, what I would say is, I think there are ways for people to get money that they don't often think about, right? They may think, yeah, I have a job and I have a budget and I can only spend so much to do certain things. But I think a lot of us have either junk in our garage, or stuff in our house, our rooms that we could sell, right? For me, that was I didn't have to do that, but I know that for my son, one of the things he had to do was sell part of a collection that he had in order to get some cash so he could start um, he could deposit that into his trading account and he can use that for options trading. Now, I'm not saying that you need to do that. Each of us needs to look at what our resources are, what we can and can't do. But if you're short on cash and you're looking for some way to make some quick cash, what you can do, I would say there must be something in your house worth value that you want to get rid of that you haven't used. um, Not my place to tell you what to do, but that's one of the ways that you could take a look at finding ways to access some quick cash, maybe. So that I just put that out there, and really the whole point is it doesn't take thousands and thousands of dollars to be a successful options trader. I've got some examples on my YouTube channel where I've demonstrated options trading with a small account, and so I would suggest that if I can do it, I think other people can do it as well. And if they don't have the money, there are ways that I think folks can maybe generate some extra cash. Maybe it's working overtime extra on your job, picking up an extra shift, or selling and liquidating some property that you already have for some cash. All right, enough said about that. Let's walk through a live example of a covered call trade. Um, Let me bring this up here. Go over to Yahoo Finance. This is a free website. Let me clear my picture out of here. You don't need to see me. Uh, there we go. Yahoo Finance is a great resource. It's a free resource. Everybody or anybody with internet access should be able to get here. And it's a resource that I use, and you'll see it a lot on my YouTube channels. I use this resource a lot to do research and get information about stocks. And the one I want to talk about specifically for this video is Under Armour. Under Armour Incorporated, stock symbol UAA. So I'll go ahead and plug that into Yahoo Finance. And Yahoo Finance gives us some information about the stock, right? So we can see the current stock price is $10.92. It's down 12 cents from the close yesterday, which represents a 1%. It's down 1% from yesterday. In after hours market trading, you can see. So this is after the market closes. There's some aftermarket trading. It's now trading at $10.98. Good to get information about the company itself, some of the fundamentals. Like, for example, the market cap of this company is $4.8 billion. So not extremely huge, but it's a good sized company, $4.8 billion. I also like to look at the trading volume, and specifically average trading volume. You can see it. It trades 7.1 million shares. What that means, or what that tells me, is that there's plenty of retail and institutional traders buying and selling this stock. And I like that because what that means is that there's liquidity. If I'm holding this stock, I know that if I need to sell it, excuse me, I know that if I need to sell it, there's a market of buyers out there willing to buy this stock. Or if if I want to acquire this stock, I know that there's sellers selling this stock as well. So that's what the liquidity means, is that there's um, a trading base, whether it's retail investors like you and I, or institutions like mutual funds, Vanguard, some of these other companies, Fidelity, that are buying and selling this stock. And so this is a great way to look and identify a little bit about the company. There's some other values here that I explain in some of my videos, like the beta value. What does that mean? The PE ratio. I think these are helpful to know. But for right now, for our purposes of what we're doing, I think it's just good enough to say, hey, I'm looking at Under Armour stock. I use Yahoo Finance to do some background information. And I like to see companies that are large enough. So in this case, a market cap of $4.8 billion, got lots of trading volume, which tells me that, you know what, I think I might like to own this stock because I think it has some potential, or possible potential, right? All the right factors are there. It tells me it's a large enough company and there's interest in it. So the next thing I would do is take a look at the chart, right? And don't shy away from a stock chart. It's going to be a helpful friend to you. So part of the technical analysis, you just input Here I'm using tradingview.com. You just input the stock symbol UAA, and you can see here Under Armour Incorporated, trading on the New York Stock Exchange. So you always want to verify that. So you go ahead and click there. And what that does is it brings up a daily chart. So you can see here, here's a daily chart. In fact, let me make it a little bit easier. Maybe you're not used to the candlesticks. Maybe you like to see the line chart. Maybe that might be easier. Very simple, right? So I brought it down to its basics. You can see the stock price over time. Now this chart goes back to the beginning of this year. So you can see January of 2022. It's here. Then you can see February, and then March, and then April. And here we are in May. And you can see the stock price is, right at the $10.92, just under $11. And what I noticed here is that this price is actually pretty low, right? From the highs of where it used to be. It used to be, what is it, beginning of the year trading just over $20 per share. And so now we're down almost 50%. What's going on, right? Well, one of the recent dips that we can see, in fact, we can go ahead and measure this. If we take a look at this peak here to where the low point here, it's down about 36% in a matter of days, our trading sessions. And we can see that's related to the earnings report that they came out with on May 6th. So just 10 days ago, Under Armour gave an earnings report where they reported their earnings were down, right? So they said their earnings were at -1 cent per share. The industry analyst estimated that the earnings would be 4 cents per share, but as it turns out, Under Armour reported a negative earnings, and so they got a negative 5 cents, which is down 125%, and also the revenue was down. So the industry analysts estimated the revenue to be 1.3 billion, and Under Armour only reported 1.30 billion dollars. And so these two negative aspects, right, these two black marks, if you will, caused the stock price to dip quite a bit, right? So it was trading around on $15 per share. The earnings report came out. Now it's down around $10, $11 per share. And so for me, this indicates something that I like to call an oversold condition. I think too many people got off the Under Armour bandwagon, so to speak, right? So they decided to sell their shares, and you know what happens, right? Supply and demand. If everybody's selling their shares, then the demand goes down, which drives the price down. But I think the price got driven down too much, and it's in an oversold condition. So now let's take a look at what the industry analysts are predicting as far as a one-year price target for this stock. There's a total of 19 industry analysts. They give this stock a moderate buy recommendation for the next year. And it ranges from a one-year low price target of $9 per share to a one-year high price target of $36 per share, which gives, if you look at all the industry analysts, they have an average one-year price target of $18.41. And so that gives this stock an upside potential of 68%. Now, obviously, there's no guarantee that the stock price will ever reach this price, right? There's no way to predict. Nobody has a crystal ball. No one can predict the future. So we don't know if the stock price will go up to $18 or to $36 or drop down to $9, or if the company will go bankrupt, or if the industry picks up all of a sudden and the revenue doubles. We have no idea. But the industry analysts, their job is to take a look at a company, the current market trends, the global influencing factors, the macro and microeconomics, and make a prediction. And on average, they think the stock price might reach $18.41 over the next year, the next 12 months. No way to know that. I personally think the stock price is too low, right? We saw the stock price, let me move this out of the way. We saw that the stock price dipped below, well, it's actually, what is it? Looks like here the stock price dipped to under $10 per share. Super, in my opinion, super oversold, and we should see the stock price go higher. And so I want to try to take advantage of this. And the way I could do this is, let's say I hold 100 shares of Under Armour. Well, I would sell a covered call. Let's take a look at the option chain for this stock. So I'm going to put in the symbol UAA for Under Armour, and we can see that it's trading at $10.98 in the after hours. And I'll press here where it says Trade UAA Options. So press that. And now I'm interested in selling a covered call. And I'm going to pick an expiration date. Let's go out a couple weeks. I'm going to say June 3rd. And here, if we take a look at the different strike prices, here on the left-hand side, we can see a strike price that some are below and some are above. And this has to do with the option being in the money or out of the money. And I explain this in some of my other videos. Go to my YouTube channel and you can learn more about it. Or maybe I'll make a separate live stream and we could talk about that. But in particular, let's say for this example, I own the shares. Let's say I own the shares at $10.98, right? Let's say I just bought them. What could I do? Well, I could sell a covered call with an $11 strike price. So if the price goes up and reaches $11, I'll make 2 cents per share. But in addition, I'm getting paid 54 cents per share in premium. So let's actually plug these numbers into a worksheet so it makes it a little bit easier to understand. Okay. So I have something I call my picking stocks for options analyzer. And I'm going to click on the covered call tab here, covered call analyzer portion. And I'm going to put in the symbol UAA. And I'm going to set the expiration date for, what did I say, June 3rd with an $11 strike price. And it's currently paying 54 cents per share in premium. And let's say that my cost basis is the $10.92. So that was the price when the market closed, not so much the aftermarket price, but it's relatively the same. And so if we take a look at my analyzer, we can take a look and see that, with the June 3rd expiration date, that's 18 days away. And so this option contract is roughly 3 weeks in length. It's just short of it, right? So full 3 weeks would be 21 days. But we're going to round up and say, this 18 days represents 3 weeks. Now I've got a $11 strike price that I'm using, and my cost basis is $10.92. So that's my break even, if you will. So right now I have, in this example, $1,092 tied up, as the value of these shares. That's what I paid for these shares. And if this option contract actually gets exercised, I would receive $11 per share. And so that would give me a price appreciation profit of only $8, right? So it's the 100 shares times $11 per share, which is the strike price. And I would subtract my cost basis, which is the $1,092. So that difference, that $8, that's my price appreciation. So that's not very much, right? It's a tiny amount. It's less than 1%. By the same token, I did receive $54 in premium as a premium payment for selling the covered call option contract. And that $54, that represents a gain of just under 5%. So I made 5% just for selling the covered call option contract, or just under 5%. So for owning the shares, selling a covered call, I'm able to generate 5% in 3 weeks, this 18 days. And that money, that $54, that's mine to keep forever. Remember, I showed you in the example, it doesn't matter what happens, the disposition of that option contract, whether it gets exercised and my shares get assigned, I keep the $54. Or if the option contract expires worthless, I keep the $54. And so best case, or let's say my shares get assigned, and that's the best case. My shares get assigned, I receive payment, that $8 profit I talked about. I would receive a total maximum profit of $62, right? So that's the $8 for the price appreciation plus the $54, the premium payment. So that's a total of $62. And that $62, that represents a total profit of 5.68%. And that's based upon the $1,092 I have tied up in my shares when I initially purchased them, right? So that was my cost basis. So in 3 weeks, I made 5.5%, just over 5.5%. And what did I do? Well, I bought the shares, I wrote a covered call, or sold a covered call, I collected the premium, and I just sat there and waited for the 3 weeks to come. And on the expiration, my shares got assigned. And so I got the $8 from the price appreciation and the $54 from the premium. and I made $62. Well, what if I didn't get my shares didn't get assigned? Let's say the market price finishes at $10.99. So it's 1 penny short of my strike price. Well, as I showed you, that option contract expires worthless. I don't collect the price appreciation profit because my shares don't get sold. I still hold on to my shares. I still have the 100 shares, but I keep the $54, that premium payment, which is 4.95%. So either way, whether my option contract gets exercised or the option contract expires worthless, I'm making, anywhere between 4.95% and 5.68% over 3 weeks. Now, I realize that's not a whole lot of money. It's not life-changing money, right? $54 or $62, depending on which way the option contract goes. That's not life-changing money. It's not. I'll be honest with you. But let's say I have multiple contracts, right? Let's say I sell 2 contracts. Or, what happens? Well, now I'm talking about receiving a premium payment of $108. Or let's say I have 1,000 shares of UAA. So with 1,000 shares, I could sell 10 contracts. Now we're talking about receiving a premium payment of $540. So you can see how this starts to add up. But smaller account, maybe I only have the 100 shares. I sell the 1 contract, I make $54. But that's $54. That's just under 5% for 3-week investment. I would ask of you to take a look at what you're holding if you're currently investing in anything. How many investments do you have? Ask yourself this question. How many investments do you have that are giving you a 5% return or 4.95% return in 3 weeks? Some of you will have that. Some of you won't. But take a look and see if you're one of the ones that doesn't have a 5% return in 3 weeks. Ask yourself, is that something you'd want? Could you do this? And my answer to you is yes. This is really simple. It's selling a covered call. I showed you. I walked you through the steps of selling the call, right? I showed you of how I would find this strike price and pick the one that makes the most sense for me, right? So let me finish out this example, right? So I'm selling a covered call with a June 3rd expiration. I could have picked different expirations, but I'm picking June 3rd. I'm using the $11 strike price, which is currently paying 54 cents per share in premium. So I could go ahead and click that. And now we can see if I hit continue, it's going to let me review my order. And what I'm doing is selling 1 contract with a 54-cent per share premium. And so I would receive that $54, right? Because it's 54 cents per share times the 100 shares would be $54. And that's how I come up with this premium amount. All right. So that's a quick example using some shares of stock that I hold, Under Armour. And if I didn't hold them, I could just buy them tomorrow and use those shares now to sell the covered call. And I showed you exactly what I would do and the profit I would expect to get from it. So this is my strategy, right? Sell the covered call, collect the premium, that $54. And if it doesn't sell, if the option contract expires worthless, well, that's awesome. That's just money in my pocket, and I still keep my shares. And so that's really the premise of what I'm talking about is selling the covered call. Let me see. Selling the covered call, using the shares that I have as the underlying security, getting paid the premium, and then keeping that premium when the option contract expires worthless. And guess what? I can do it again. I can sell another covered call using the same exact shares. So I'll use the same exact shares, sell another covered call, and collect more premium payment. And I can do that every month or every 2 weeks. It just depends on how long the expiration is set for. I showed you I used one for 3 weeks. So every 3 weeks, if I wanted to do this, I could use my same shares, sell another covered call, and if the option expires worthless, I'll do it again and repeat the process. But let's say that the market price goes above my strike price. Well, then I'll get maximum profit, right? I'll end up selling my shares. They'll get assigned to the buyer. I'll collect payment for those shares, and I still keep the premium that I received, and that's how I'm going to maximize my profit. And now I could use that money to go buy more shares and then sell another covered call, or buy more shares of a different company. It just depends. There's so many different ways to go about this, and there's many different strategies. But I wanted to share the simplest one, the one that I started with, and it's selling covered calls. And I already had the shares in my portfolio, right? I was a buy and hold trader, and then I was a swing trader, and it was a natural progression for me to just go ahead and sell the covered call. Some of you may be thinking, well, I don't like to sell. I'm not a person, and I'm not a person who can sell. I don't talk to people. You don't have to talk to anybody. I do this completely at home, from my home office, on my laptop, and I don't talk to anybody. I don't have to talk to anybody. When I submit my order to my broker, they take care of the entire transaction for me, right? So they're selling it for me. They're collecting the premium payments for me. They're depositing it into my trading account. If the shares get sold and assigned, they're collecting the money and they're depositing that into my account. If the auction expires worthless, they tear up the contract. They know I keep my shares, and they know that I keep my premium payment. I don't have to do anything like that. I'm not knocking on doors. I'm not calling on the phone. I'm not talking to anybody. It all happens with my broker taking care of that for me. I don't. It doesn't require thousands and thousands of dollars. I showed you where. Go to my YouTube channel, see some of those videos where I'm using a small trading account and I'm executing these trades, and I have $500 in my trading account, or $250 for a trade. I've got some examples in there, and you can see that's very possible to do this. It's not that hard, right? I taught my son, who's a high school student, or a high school student at the time, how to do this. Not a math whiz, neither am I. We didn't have financial backgrounds, but by the same token, I'm not squeezing every last penny out of this trade. There are some things that I could do. Instead of making 5%, I can make 5.5 or 6%. Um, and I admit that, right? So there's folks that are smarter than me, doing a lot with these same trades, but they're adding some complexity to it, right? So they're purposely trying to squeeze out every last penny from it, and I applaud them, right? That's awesome. If they want to do that, great. I didn't want to do that. I'm looking for something that's a little bit easier, where I don't have to learn a lot. Now, doesn't mean that I don't know it. It just means that for my everyday trading, I don't need to use it. Some You may hear the term the Greeks, right? The delta, theta, gamma. Some of the things you'll hear, and I understand what they are. I know how they apply to options trading, but do I use them in my everyday options trading? I don't. Um, and I get criticized for that, right? I'm not paying attention to the Greeks. Well, I do, I guess, a little bit, but it's not. That's not how I'm doing my options trading. Again, I'm all about simple option trading. That's why my channel is the way it is, and I'm sharing with you the easiest way for me to do it and to teach someone else to do it in order to be profitable and generate a monthly income. Or in this particular example, every 3 weeks, right? I'm collecting that premium payment every 3 weeks. Now, depending on the option and the option chain, that premium payment will be higher or lower. So, and in fact, if you look at my videos, you'll see some option trades where I sell covered calls and I'm making hundreds of dollars in premiums. And those option contracts expire worthless. And so I end up keeping the premium payment, the hundreds of dollars in premium payments. Those are mine to keep. And there's examples that I've documented, and you'll see them on my YouTube channel where I've gone through and done that. All right, let's move on, right? Enough of the dwelling on it's simple and easy to do. I showed you an example. You'll see some of the comments on my YouTube channel and a lot of my videos where people are saying, hey, it actually works for them. And now I think you're actually ready to go, right? So I really described how covered calls work. Well, first I described what a covered call, or I described what an option is. I described what a covered call is, and I showed you how it works, right? The relationship between a buyer and a seller, and having those shares allowed me as the seller to create a covered call and sell it. A buyer that was interested in it paid me the premium, and then I showed you what the outcomes were, right? What happens when you sell a covered call and when you buy a covered call, and then what happens on the expiration date when the option expires. And it's either in the money or out of the money, right? So the stock price, the market price is above the strike price or it's below the strike price. So I showed you how that worked. And also showed you how I use this to make money, right? It's for me, I like it when the option expires worthless, because I keep my shares and I keep the premium payment, and that for me, that's a way for me to generate an income on a regular basis. And as I mentioned, if the option expires worthless, I keep the premium, I keep my shares, and I can use those same exact shares to sell another covered call and collect even more premium. And so I could do this over and over again. And that's really what it's all about. It's very simple, right? I think um, I haven't given you all the details, but I think I explained enough of it where um, uh, you could probably go out to your trading account, talk to your broker, watch some other videos to feel comfortable enough where you could probably actually execute your own covered call for the first time, right? I think the information I've given you shows you that it's not that hard, not that difficult, and what the outcomes are, what you can expect, and the kind of money you can make from it. So I'm hoping that you got your questions answered. But if you do want to know more, I invite you to come on over to. I've got a Discord channel where it's a user community of option traders just like myself and yourself, where you can ask me questions directly, and I'll give you some answers. I'll answer your question if you've got questions about, well, how does this work, or how does this other thing work, or what's really behind all that. I'm more than willing to um, entertain questions. I've got me and my team there. We'll answer questions for you and give you your answers. And so simple enough. You just head on over to discord.simpleoptiontrading.com. That's my Simple Trading Rube community, my Discord community. And like I said, I invite you over to come ask me questions, get more information about options trading. And I think you'll find it's a helpful resource. Um, in fact, if you come on over, you'll also see that I've got an announcements channel where I talk about some of the news and market conditions and things to watch out for, right? Some of the things that are coming up, and which I think is very useful for some folks who may not have the time or inclination to always keep track of what's happening, what's going on. And so I try to provide information I think is relevant to us as options trader. I also give key insights, some of the stocks that I'm watching, my trade alerts, right? So I'll tell you about stocks that I think are in a potentially profitable situation, and what I might be looking at as far as doing an options trade. Am I going to do a covered call? Or what are some of the other strategies that I'm looking at? And so that coupled with the announcements, right? So you know what's going on in the market. You know what stocks I'm looking at. And I'm also letting my community know, everybody, all the members know that I'm going to make a trade. And here's what the trade looks like. So you get that information. And I think it's super helpful. And again, I'm not recommending that you follow me or you do what I'm doing, but I think it provides some more information for you as you decide if you're going to make trades, you want to protect your money, you want to make smart investments or minimize your risk. It's sometimes helpful to know what other people are doing. So I don't mind sharing that. Come on over and you'll be able to see some of that information. And then when I do make the trade, I'll publish the actual trade that I make, right? So you'll know here's the stock, here's the strike price, here's the expiration date. Um, and it's very transparent. So you'll know um, the trades that I'm making, and it's a way for you to say, okay, I'm going to follow Jim and what he's doing because now I've got all the information about his trades. And so that's one of the things I publish in my Jim's trades section. So you find out about what's going on in the market. You find out what stocks I'm watching, as potential option trades. Here's a list of what I think might be good to look at, or at least what I'm looking at. And then when I actually execute on it, you'll actually see my trade. So you'll know, you get to follow it from beginning to end. Um, the entire genesis. What's the stream? What's the workflow? What am I doing? How am I getting my information? What do I narrow it down to? And then what am I actually using my own money to execute these trades? And I think that really speaks volumes, right? So if I'm giving you the information and I'm telling you, hey, here are the 5 that I'm watching, or here are the 10 that I'm watching this week, whatever it happens to be, and then I actually make the trade, that means I'm putting my money where my mouth is. I'm actually buying or backing up what I'm saying that I'm doing, and I'm showing you my actual trade. So what I'll do is I'll take like a screenshot or a screen capture of my actual transaction record in my account history, and I'll publish that to my Discord community. So if you're in my simple trading room, you'll be able to see all that information. Let me go ahead and do this just as a reminder. There. So if you wanted to join, there it is, right? So don't want to join, you don't have to join. I'm just saying it's there and available. It's one of those things. All right, what else? And then, of course, as I mentioned earlier, I've got an Ask Jim section. Ask me the questions. Me and my team will get back to you with the answers. You need more definition about how something works. You want clarification on something. You're confused about some of the steps and you want me to fill you in, or you want to know how certain things work. That's what this section is for, right? So, with all the news, the stocks to watch, my actual trades, you still might have questions, right? So it initially it may look simple, right? Where I've got the news and what the possibilities are in my actual trades, but you still may have questions, right? Why did I do this? Why did I pick this strike price? Why did I go to this expiration date? Well, here's the perfect chance for you to ask questions like that. And now, and that's really all I wanted to talk about. I'm going to go ahead and we'll do our own Q&A session. I mean, as long as we're here, right? If you've got questions, I'm going to go ahead and take a look at the comment section to see if there's anything there. Let's see. Seth says, appreciate the content you make. Helped me learn options last year. Puts were probably the most confusing. Okay. I'm happy that the content, or I'm glad the content has been helping you. Again, my YouTube channel is out there. I've got I think roughly 200 videos published there. Maybe not. It may not be there, but I'm getting close, I think. And so it's a way for me to share with you information about options trading and the different strategies that I'm using. And again, I'm not saying you should follow what I'm doing. My intent is to provide information to you regarding where I've been, what I've learned, and here's what I'm doing. And hopefully you don't make the same mistakes I made. But and maybe there's some different strategies that you haven't thought of or you've never used. And so watch my videos. They're all for free on YouTube, and you can find out about some of the different strategies: covered calls, cash secure puts. I do leaps. I do the wheel strategy. I also do spreads, vertical spreads, credit spreads, debit spreads, and there's a lot of information there that I hope is helpful to you, and everyone. And then Seth also says that puts were probably the most confusing. Hey, so you know what? I'm going to do, Seth? I think for my next live stream, let's maybe next week. How about next week we do the same exact live session? We'll do one on, I guess, Monday. What is that? The 23rd, Monday the 23rd. Unless you hear otherwise, I'm going to hold another live session, and we'll focus on cash secure puts. We'll do cash secure puts as an option trading strategy. At that point, I can also factor in how they work as part of a wheel strategy, maybe. We could also talk about doing put credit spreads and put debit spreads, so some of the vertical spreads as a trading strategy. And hopefully I can help answer some of those questions as well about, how do the puts work versus call options. The one thing I avoid, one thing I don't do naked calls. I don't do naked puts. I think there's a lot of risk with each of those strategies. And for myself, I understand them. But for my own personal risk reward, that's not a place I want to go to. And that's probably the one thing I recommend or I suggest or tell people about is I don't do it. I think there's too much risk. And so I would never recommend for anybody to do naked calls or naked puts. Just throwing that out there. Okay. All right. What else we got here? Orion Gonzalez says, I'm doing the will strategy on Apple. Seems the best option for now. Then after Google split, I'll also do that one. Oh, okay. Awesome. Right. So we talked a little about, I mentioned the wheel strategy, right? And it's a combination of using covered calls and cash secure puts in a way that they work off of each other, right? So the output of one feeds the input of the other, and then that output feeds goes back and feeds the input of the other, right? And so it's by repeating that process is called the wheel strategy. And what I need to do then, I mean, that's a great comment, right? I need to I need to reveal or discuss a little bit about cash secure puts, and um, and then at that point you'll have the information you need. You'll understand covered calls, you'll understand cash secure puts, and then I can start putting the two together, and I could do another live session just specifically on the wheel strategy. And it's an awesome strategy. If you're not familiar with it, um, uh, it's a way for you to make money in this wheel, this repeating basis. And as I mentioned, it's the output of one feeds the input of the other, and it just goes on and on and on. And it's a way, you could hold 100 shares of stock and sell it, and then if it gets sold, you buy it back using a cash secure put. I'm getting a little ahead of myself, but you can use cash secure put to collect money on that transaction, and then it feeds itself. And if you get the shares, you use that as a covered call. It's an awesome strategy. I may not be explaining it very clearly right now, but I think once I lay out covered call and cash secure put, you'll see how it's possible to keep making money. And here we see one of the members actually doing that, or one of the users actually doing that, um, using the wheel strategy. And I love the wheel strategy, and I seem to always have a wheel strategy going on in one shape, form, or another. And then this user also talks about after the Google split, I'll do that one as well. And if you haven't heard, shares of Google and also Amazon will be splitting. And I think Amazon was doing a 20-for-1 split, meaning if you currently hold one share of Amazon, after the split, you'll own 20 shares of Amazon. Now, don't get too excited. You're not making any more money. They're just they're increasing the number of shares you hold, but the value of those shares will decrease as well by the factor of 20. So, for example, let's say you have one share of Amazon, and it's currently at $2,000 per share, right? So one share, $2,000. If I do a 20-for-1 split, what happens then is I end up with 20 shares of Amazon, but now they're only worth, what is that? 2,000 divided by 20 is 10. So now that the value has dropped, I'm sorry, 100, $100 per share. Oops. Like I said, not a math whiz, right? So you own 20 shares of Amazon, but now they're only worth $100 per share. So the net value, right? So it's one share at 2,000 or 20 shares at 100. The total value is still only $2,000, but because of the split, you now own 20 shares, and the cost of those shares is a lot lower, which means the entry point is a lot easier or more affordable for some folks, right? Maybe you can't afford $2,000 to buy one share of Amazon, but maybe you're in the position where now you could buy a share of Amazon for $100, or maybe 5 shares for $500. So you can see how that kind of works. And so that's what this user is talking about. This member's talking about Google splitting. So Google's going to do something similar. Well, go back to Amazon real quick. So Amazon's doing a 20-for-1 split. I believe it's June 6th of this year. So next month coming up, they will do a 20-for-1 split. And the owners of record on that June 6th date, however many shares you hold, will get multiplied by 20, but the share value will actually decrease by 20 as well. Now, the Google split, I don't know the details. I think it's also a 20-for-1 split. I'm not sure. And I also don't know the date of record. Maybe someone on this chat knows when the Google split is going to occur and the number of shares and the date when it's supposed to happen. If you happen to know that, go ahead and type it into the chat and we can share that with everybody. But that's what's happening with Amazon and Google, that they'll be splitting and making the shares more affordable, if you will, and then make it possible to do some option trading. All right, let me see. What's the next one? Ken Johnson says, if the stock jumps, you miss out on the run. Only sell covered calls when stock is rising, not on a bear market. Good point, right? So I think I mentioned this, is that let's say that my strike price is $100, but the stock jumps up to $1,000. Me as the seller, guess what? I don't get to take advantage of that. Even though those shares are worth $1,000, my option contract says I'm obligated by contractual agreement to trade or to sell my options, and have them assigned to the buyer $100 per share, whatever the strike price happens to be. And so I miss out on whatever that run is, right? So if the stock price jumps to the moon and they're $1,000 per share, guess what? My covered call means I can only sell what the strike price says. And so in the example I showed you, it was $100. So I would miss out on that $900 gain that the covered call would make. So, that's, a lot of people will get mad. I look at that and I say, yeah, I did miss out on the upside potential. But by the same token, using a covered call vice some other mechanism, I'm minimizing my risk, right? So the downside potential is minimized, and as a result, my upside potential is also minimized, right? So there's caps or limits on that, and that's one of the first slides I talked about in the beginning of my presentation. Is that, yeah, covered calls, I can avoid that infinite loss, but I also avoid or miss out on that infinite gain, that the possible potential. As Ken had mentioned, I miss out on the run. I give you that. But allows me to program in exactly what I want to get, that I'd be happy with. So if I purchase my shares at 90 and my strike price is 100, well, even though the shares jump to 1,000, I have to sell at 100 and I'll make $10 per share, right? I still make a profit. I don't make as much profit, obviously, but that was the price that I agreed to contractually. If I wanted to make that $1,000, I should have set my strike price at $1,000. But I'll tell you what happens. I set the strike price at 1,000, and no one buys my covered call option contract because nobody thinks it's going to go that high. And so as a result, I don't collect any premium. I don't sell the covered call option contract, and that's not the point of my strategy. The point of my strategy is sell the covered call option contract, collect the premium, and if the option expires worthless, great, I keep my shares and my premium. But if the option gets exercised, that's okay. I'm selling it at a strike price that I'm okay with. I agree to it, right? If it reaches 100, I'll sell it, and I'll keep my premium. And so that's the trade-off there. Only sell covered calls. Ken also says only sell covered calls when the stock is rising. Great point. I think in one or more of my videos, I talk about best time to sell a covered call, and what's known as a green day, right? So if you look at a chart and you see the green bars, you want to sell a covered call when the stock price is rising. And next week, if we do cash secure put options, you'll find out the opposite is true. You only want to sell a cash secure put when the price is falling or in a red candlestick. And you don't have to do it, but if you want to maximize or get as much profit as possible, you'll sell covered calls on up days and you'll sell cash secure puts on down days. Now, you're not required to do that. You could sell a covered call on a down day, but you're not going to make as much profit. So I'll just tell you that. And so if you've got questions about that, come on over to my Discord, send me a question. Me and my team will answer the question and give you all the specifics behind there. Or also check my YouTube channel. I've got some videos on that as well. Okay. And then Ken follows it up, not in a bear market. Right. So Ken, I 100% agree with you. If the stock jumps up, you miss out on the run. I agree. Sell covered calls when the stock is rising. So that's that green candlestick, maximize your profit. You get more premium, is really what it turns out. You get more premium and a higher strike price possibility when the stock is rising versus when the stock is in a bear market, or, the price is dropping down. You won't make as much money. You have to pick a lower strike price. It's just not as profitable. You can still do it, but Ken's right. In order to make the most profit here, follow these rules, and you'll. So, all right. Let's see what else we got. I got another comment here from David Lang. David says, finding the right underlying stock to trade on any given day would be really helpful. You did one a while back, which was amazing, but I missed a lot of it. I did. I did a live session where I talked about picking stocks for options trading. And what I plan to do is hold another live session just like this one, where I'm going to focus on a different topic each time, and I'll do one on picking stocks for options trading, because that's, if you look at it, that's kind of where it starts, right? You have to know what stocks to use in order to do options trading. Well, you don't have to, but it helps. Uh, you want to pick stocks where it's favorable, right? The conditions are favorable for yourself as the options trader. The momentum is working to your advantage, and so I want to share with you in another live session how I pick stocks for options, and that's been part of my secret of success, if you will. What stocks do I use for a covered call or a cash secure put or a wheel strategy or a debit spread or a leaps option or poor man's covered call? There's all these different strategies that I use. And a part of it is being able to pick the right underlying stock. And when I say right underlying stock, I mean, there's no magic here. It's not that I'm going to pick one and it's going to be a winner 100% of the time. But I want to pick a stock or utilize a stock where it gives me, some potentials, a better potential, right? So if the odds are in my favor for using this stock versus some other stock, well, I want to use this one. And so that's what David's talking about. So hopefully you can join me for that session as well. We'll have to figure out, all the different sessions you folks like to see. Send me comments, send me emails, let me know. I did this one today was on covered calls. Next week, I think what I promised to do is one on cash secure puts. Using that as a strategy. Maybe at that point, maybe the follow-up is picking stocks for options, or maybe we talk about some of the other strategies. There's lots of different ways this can go, and really the best way to kind of push this in whatever direction you want. Leave me comments below on my videos. Tell me what you want to see. Come on over to my Discord. Tell me what you want to see. And that's probably the best way. And wherever I see the most interest, right, the squeaky wheel gets the grease, as they say. And I'd be more than happy to jump into some of these different topics and share with you what I'm doing. Again, I'm not an expert. What I do have, though, is an open forum where I'm sharing information, right? So I've got this Q&A chat channel in my Discord. More than welcome to come over and join. And we could talk more about it. Okay, let me see. Any more questions or comments? I don't see anything in the comment section. I'm going to go ahead and wrap it up. We've been on, an hour and a half now? Oh my gosh. Didn't really mean for you to be tied up this long. Let's see. Oh, David just posted another one. He says, I tend to go back to the stocks I know and are watching because I like those stocks. Problem is that I end up with too many underlying stocks in the same sector. So when the sector goes bad, I'm stuck. Yeah, that's a good point. I do the same thing, right? So if I know how a stock operates under different market conditions, I tend to like those stocks, and that's one of my trading rules that I actually follow to some degree, right? If you always trade shares of Apple or Tesla or Coca-Cola or Wells Fargo, then what happens is, and there's an advantage to doing that. It's because you're so familiar with that stock and you trade it so often. After time, you get to see how that stock acts and reacts to different market conditions, which is actually a good thing, because now you can start anticipating, what the stock price might do if certain conditions in the market exist, right? And that allows you to save time, because you know what the stock does. You don't have to do as much research, because you know that when gas prices go up, there's less internal combustion engine cars being purchased. And so maybe the companies that are involved with electric vehicles whether it's an EV company or an associated company, maybe these supply parts or charging stations, maybe those stocks might start moving higher, right? As the population starts driving less gas powered cars and starts driving more electric powered cars. I just use this as an example. Doesn't necessarily mean it's true, but maybe you see some of those trends there. And so if you're following stocks, um, Coca-Cola, maybe more people drink Coca-Cola during the summer, and so and less people drink it during the winter. So in the winter, you buy more shares, and during the summer, you sell shares because the stock price tends to go up during the summer and drop down in the winter. And so by knowing those stocks and trading them frequently, that's not necessarily a bad thing. It's like I said, it saves you time. You don't have to do as much research, and over time, you figure out how that stock price tends to trend over the year. Maybe there's different market conditions that are coming up, or maybe it's seasonality, right? So Christmas season, we may see certain stocks for companies going higher because it's Christmas time, and then after Christmas, the stock price may drop. And so you know that because you're familiar with how that stock acts and reacts to the market, seasonality, conditions, things of that nature. So not necessarily a bad thing, but as David mentioned, though, if you have too many stocks in a sector and the sector goes bad or the industry goes bad, then you're kind of left holding the bag because you have so many stocks. You're overweight, so to speak, in a particular industry or a particular sector. And so when there's an inflection point and there's a downturn, well, guess what? All of those stocks will be affected by it. Obviously, on the flip side, if that sector or industry goes up, then all of those stocks will tend to go higher. No guarantee, but that's kind of what we see. And so it's a trade-off, and that's why you hear about diversification is important. And so if you find yourself overweight in a particular sector or industry, maybe it's time to take a step back, take a look, reevaluate your portfolio. Maybe you want to rebalance or readjust. But like I said, it's not necessarily a bad thing. And, it just depends on each individual and their own individual risk assessment of their own portfolio, where they're at, where they want to be as part of their investment strategy, right? Are you earlier in your investing career or later in your investing career? And so you have to be more protective. Or are you younger and you can afford to take more risks? It just all depends. All right, let's see. Hour and a half, oh my gosh. Almost an hour and 40 minutes. All right, I don't see any more questions. I'm going to cut it off here. Let's do this again next week. I'll hold another live session, and I'm going to pencil it in. We're going to talk about cash secure puts and how we can use cash secure puts to make profits. The strategies that are involved, how they work, strategies involved, how I've used them. And then we'll actually use that as an introduction to the wheel strategy, because you need both parts, right? You need the covered call and you need the cash secure put in order to do a wheel strategy, which is another fun way to make money on this rotational basis. It's really awesome. So thank you so much for joining me. I really appreciate it. If you have time or you have interest, check out my Discord, my Simple Trading Room community, like-minded individuals, and you're welcome to ask questions, get your answers, get the answers to your questions, find out about my trade alerts, what stocks I'm watching, things of that nature. All right. Hope you have a good evening or rest of your day. I really appreciate all of you. Again, I'm Jim Ray. Thank you for joining me on my Simple Trading Room community. I'll talk to you later. Bye for now.